Now, the first thing, that technicals are best used when there's a clear fundamental bias for the direction of the instrument to move a certain direction. So say there's a escalation geopolitically, we might know that gold is very likely to rise. So we'll be looking for a gold long bias, for instance. And we do that, every single day, looking at instrument biases based on market breaking news and scheduled economic data events. But what the question is asking, are there any times you can just use technicals without a catalyst? And the answer is yes, you can. But what you need to find is you need to find a situation where you have a very strong technical level and there's no reason for that technical level to break. So let me just give you an example here with the euro US dollar. Okay, I'm just going to use a technical, so just forget the situation that euro US dollar is in right now. Okay, and just look at this technical area here. So here you can see you've got a potential trend line. Okay, you can see price starting to move to the upside. If we just did a trend line across the top here, we can see that price, has been flirting with this level. It's trying to break higher to the upside. Whether it does or whether it doesn't, to be decided. But technically, we can see that, if there is a move back down to that level, you would expect a little technical bounce. Now, the trick is, as it were, is to find a time to enter when there's no major market breaking news, or if price moves down there's nothing to mean it breaks through that level completely. Okay, so what you want to find is a really strong level, and the best kind of levels for these sort of technical bounces are your major weekly levels. So you see here, you got a big weekly level. Okay, so if the euro US dollar moved down to that level, and say there was no reason for the euro US dollar to take fresh lows, you'd expect the bounce, 30, 40, 50 points. That wouldn't be unreasonable. You could also look at this potential trend line here. If price moved up to there and there was no reason for it to go above that trend line, you could expect a little bounce. Now, the problem with these bounces can be where do you put your stop? So you can see here, if you entered here at 0.7338, you might need your stops, sub 0.400, and is it worth it to have like 30 points or 20 points or 50 points on a bounce? That's the problem you've got. And also, if you get your analysis wrong, and there is a reason for the pair to make fresh lows, then you can end up, taking a full hit on, a trade that you were just looking for a small technical bounce. Another tactic you can use is wait for the Asia session. So if you've got like a European pair, and then say you're coming up to the Asia session, you might think, well, okay, it's very unlikely that euro US dollar is going to be making fresh lows in the Asia session. The downside, of course, with the Asia session is volatility tends to shrink anyway, so you don't get very much volatility. But if you were sort of hanging right on a major level, and you're heading into the Asia session, there's no major news overnight scheduled. There's nothing scheduled on the next morning, and it's light on the afternoon. You might think, oh, okay, well, maybe I'll expect a little bounce here. 10, 15, 20 points wouldn't be unreasonable. So that's the sort of thing you can do. You can do that without a catalyst, but you need to make sure you've got your levels. And the better the level, the easier it is. And you want to make sure the calendar's free and there's no reason for price just to break, fresh level. Particularly price usually wants a reason to break a level. And the bigger the level, the bigger the reasons that is usually needed. So I hope that helps give you a little idea how you can use technicals as part of a trading strategy. The difficulty comes is how do you quantify that? How do you work out how much risk? How good are you at picking your levels? There's a bit of an art to it, and that can be difficult practically to systemize that. It can leave you vulnerable to revenge trading, taking on too much risk, jumping in and out of trades too often, jumping into every sort of major level you see. So it can harm your trading as well. So it's a two-edged sword. There are risks involved with it, but you can use these technical bounces without a catalyst.